Today I want to show you how I obtained a company APV of 605.21. Some of the main things I watched when choosing different investment proposals were the revenue, the operating income, and the net income. As you can see here in 2009, we have a revenue of 245.75. We have an operating income of 22.60 and a net income of 13.56. Here in the current year of 2014, you can see we have the revenue of 334.95, an operating income of 39.53, and a net income of 23.72. When deciding which proposal I wanted to invest in, I took several factors into account. Unfortunately, I am unable to show you this process because the tab has closed and the simulation has ended because I have obtained a 605.21 APV. But the first thing I looked at when choosing these investments is the NPV, or the net present value. The NPV is used to analyze the profitability of a projected investment. Another thing I looked at is the IRR, or internal rate of return, which is the discount rate that makes the NPV of all cash flows from a particular project equal to zero. I also focused on the earnings before interest, taxes, and amortization, referring to the earnings of a company before the deduction of interest, taxes, and amortization expenses. In addition to those, I also looked at the payback period, which refers to how many years it will take to recoup the funds expended in an investment. So focusing back on the dashboard here, another thing I wanted to point out is the revenue by division over here. As you can see, retail is the main form at a 235.82. The majority of operating profit comes from licensing, as you can see here in the blue, with a 24.1, and the total assets are from production, here in the red, at a 181.47. Over here on the right of the screen, you have the project updates. As you can see here at the top, we have the first being replace assembly equipment at Sacramento facility. The new machinery performed as expected. Then we have the EDI supplier software system, which is the new system performed better than expected with regard to SG&A and working capital savings. Third, here we have the children's accessory line. The children's accessory line performed well, slightly higher than budget. Next, we have doll houses and miniature dolls. This project launched successfully, but with somewhat lower margins than expected, attributable to higher production and marketing costs. And finally, we have the Young Authors book series. Best of Girls books were an immediate success with the targeted demographic. Both revenue and profit levels exceeded expectations. And this tab over here to the right is just some of the details of the projects that I have invested in. If you click on View All Updates down here, it will lead you to a page showing all the investments I have made over a span of 5 years, starting down here in 2009 and working its way up into 2013. How choosing these investments works is you have a set budget. However, you don't have to use the whole budget. You just want to focus on the aspects I listed earlier, such as NPV, IRR, payback period, and so on. These will help you improve your company each year. The next thing I want to show you is the project details, which hold all the information in determining whether the investments were good or bad. At the top of the screen here, you can see this box highlighting the project discount rate. Ultimately, what this means is that a certain division of your company will pertain that discount rate to that projected project or division listed up here at the top. If you hit this square button here, it will show you the low, medium, and high risk ranges for production, retail, and licensing for your specific project. Up here to your right, you can also see the risk of the project, the lifetime projected cost, along with the NPV, IRR, discount rate, payback period, and profitability index. This information is subjective to just the project you have selected and will fluctuate as you change it. As you can see up here, you have the previous projects and the available projects for you to select. We are looking at the toddler doll accessory line right now, and as you can see, the risk is low and the lifetime projected cost is a 3.14, and being that it is such a low number, it is also good for the company. The NPV is a 6.82, which is an average NPV. It could be higher or it could be lower. The IRR is 24.80%, and the discount percent is what we discussed earlier. Then you have the payback period of 8.70 years, and the profitability index of 3.19. So next we're going to scroll down to focus on the cash flow statement. This means you have net income plus depreciation, with the total listed down here below in bold on this line. As you can see here, it had a negative total of 0.38, but then it increased to 0.37, to 0.63, 0.76, 0.84, 0.93, 1.02, 1.12, 1.23, 1.36, and 1.49. So as you can see, it increases as the years go on, meaning these investments were a good choice when referencing the future in the company. With a trend like this, you're also able to detect the type of investments you want to make in your future. So going back up to the top, we're going to look at another project I've invested in to view the cash flow statement on that one as well. So see here, we're going from the toddler doll accessory line to the Grow With Me doll line. So as you can see, when I switch projects, the numbers and everything automatically change. You can see that this is a high risk with a lifetime project of 9.15, which is on the higher side of the spectrum. You can also see that the NPV is a 10.64 with an IRR of 20.40. If you look here, the payback period is over 10 years, but I invested anyway because of the high NPV and IRR percentage. If we scroll down again to the cash flow statement, you can see that with the net income and depreciation combined, you have the totals down here again, starting at a negative 0.90, a 0.53, 1.16, 1.42, 1.46, 1.64, sorry, 1.76, 1.86, 1.98, 2.09, 2.22, and 2.35. Again, this is a great indicator that this investment will do your company good in the future. So scrolling back up to the top, we're going to switch tabs again to the income statement and balance sheet. Up at the top here, we have a company consolidated, production consolidated, retail consolidated, and licensing consolidated. Consolidation is the process of merging or unity. Therefore, company consolidation is the merging of companies. Production consolidation is the merging of production, and so on with the retail and licensing. As you can see, if you click through these tabs, the numbers change throughout. However, we are just going to focus on the company consolidation tab for now. When looking at the income statement up here at the top, you can see that we have the net sales minus the cost of goods sold. You have the gross profit minus the increase of SG&A, which is selling, general, and administrative expenses. You can also see the EBITDA minus depreciation, which is the loss over time, and then profit loss of sale of PP&E. All of these together give you a combined total of your earnings before income taxes. As you can see here, they increase throughout the years, ending at 2024 of a 109.93 and starting at a 39.53. So it has increased pretty steadily. But you also have to subtract your taxes on the income statement. As you can see here, after you subtract these taxes, you get your net income. As you can see, it has the same effect as the earnings before income taxes and has a steady increase, ending at a 65.96 in the year of 2024 versus the start of 23.72. The net income is a significant number when looking at financial statements for your company, so seeing this number increase is a very good sign. Looking at the balance sheet here, starting up here with assets, you can see that there is an asset section and there's a liability section. Looking at the assets, you can see that there are two totals of net current assets and total net assets. Both of these numbers increase as the time goes on, meaning that the company is possessing a lot more in its benefit. And then in the liabilities tab, you can also see that it has two totals, a total of current liabilities and a total of liabilities and shareholders' equity combined. These two totals increase as well, as you can see over the span of these 10 years. However, it's not as beneficial as the increase of assets because your company will have to end up paying these back later down the road. So next we're going to look at the historical financials tab, which shows you the income statement and balance sheet in previous years versus in the future. This tab is good to reference on how well your business has performed in the past and how it is improving or decreasing as years go on. Because as you can see here, you have your current and then you have your 2009 down here as well. But the numbers throughout your totals here have increased throughout these years. So knowing that it's going to increase in the future as well is a great thing for your company. So going back to the dashboard, we can see how much capital budgeting can affect a company and how well it performs, even with the additions of differing project investments. Now that I have shown you the rundown on analyzing the information I have obtained from gaining this 605.21 APV of the company, I hope you can see the importance of capital budgeting when it comes to a company. Thank you for listening.